Today, we are tackling one of the most interesting contradictions I've seen in the market lately, and it's all happening in the Bitcoin mining space.
We're looking at Bitfarms. Ticker is BITF.
Right. And it's a fascinating setup. You have a stock that's just been, consolidating, kind of hovering around $2.60.
Just trading sideways. And that surface level look, it feels completely, totally disconnected from the operational numbers the company just put out.
Exactly. I mean, when you look at the analysis report we're pulling from, the main number just screams at you. A 156% revenue explosion year over year.
That is just, it's a massive number in any industry, but especially in mining right now.
It's astonishing growth. So that's our mission today. We need to figure out how a company can post that kind of aggressive expansion, stack up hundreds of millions in cash, and yet the stock remains stubbornly low.
Is it a true growth opportunity that's just hiding in plain sight? Or is there some kind of value trap here that's being masked by, accounting noise or something else?
Okay, let's unpack this.
The story really has to start with those raw operational numbers.
It has to. Because 156% growth, that gets your attention. We need to break down the scale of that success. What were the core numbers driving this?
So the analysis really centers its argument on the third quarter of 2025. During that quarter, Bitfarms reported $69 million in total revenue.
$69 million. And that figure, on its own, is what represents that 156% year-over-year growth.
Precisely. And that jump shows they aren't just, maintaining their position. They are actively and aggressively seizing market share.
Okay, but to really get the significance here, we have to look past just the dollar figure, right? The analysis emphasizes their efficiency.
Yes. How they actually earn that revenue. They mined 520 Bitcoin in a single quarter.
Wow.
Now, what makes that so incredible is the context. You have to remember the recent Bitcoin halving event.
Which, for anyone unfamiliar, it basically cuts the revenue you get per block in half.
That's right. So if you were making X dollars yesterday, today you're making half of X, all else being equal. Miners have to find 100% efficiency gain just to stand still.
Margins get crushed.
They get compressed dramatically. And the report notes that Bitfarms, well, they just overcame this. They achieved massive scaling while, and this is the key part, while they were upgrading their fleet efficiency.
So they got bigger and leaner at the same time.
Exactly. They managed to fight off that gravitational pull of the halving that sank a lot of smaller, less efficient players.
That suggests some seriously good management. I mean, most companies struggle just to maintain their output after a halving, let alone expand it by that much.
It really does. It speaks volumes about their focus on fleet optimization. They were clearly prepared for this.
Okay, so the operational side is clear, but efficiency alone doesn't create a, nearly $1 billion cushion. Let's move past the mining success, because here's where it gets really interesting.
Maybe liquidity.
The analysis pivots hard from revenue growth to financial stability. It highlights this massive war chest, as the report calls it.
And this cash position is, I would argue, the single most bullish factor that the the algorithms and short-term traders seem to be completely ignoring.
So what are we talking about here? Total liquidity is
approximately $814 million.
$814 million. That is a staggering amount of financial firepower for a company with this valuation. How much of that is just, straight cash?
The analysis specifies it's roughly $637 million in cash on hand.
Okay.
And it's important to note that cash came from their recent convertible notes offering, which we will get into because, ironically, that's also one of the reasons for the downward pressure on the stock.
Before we get there, let's analyze the implications of that for the listener. What's the so what of having that much cash?
I mean, the implications are profound, especially in the crypto world. Think of it as this massive insurance policy. This cash lets them survive not just a bad quarter, but a full-on, prolonged crypto winter.
So they don't have to panic sell their Bitcoin to cover the bills.
They are completely buffered from that price volatility. They get to play offense, not defense. On the aggressive side, they are perfectly positioned to acquire distressed competitors.
The ones who didn't manage the halving so well.
Exactly. They're not just a player anymore. They're a potential industry consolidator. They're positioned for expansion, not fighting off bankruptcy.
That completely reframes the entire narrative. The market is valuing them like their peers, but they aren't.
And that's before you even get to the second part of their strategy, which is maybe even more important for the long term.
The AI pivot.
This is the move that really differentiates Bitfarms from almost every other pure play Bitcoin miner out there. They are actively diversifying their revenue away from just the price of Bitcoin.
So how does that work? How does a Bitcoin miner get into the AI infrastructure game?
It's actually a remarkably smart transition. Their core asset isn't just mining rigs, it's massive, secured power infrastructure and access to cheap energy.
Right. The hardest parts to get.
So they are converting their Washington site for high-performance computing, or HPC. That's the heavy-duty infrastructure you need to train and run these huge AI models.
So they're basically renting out their power and computing infrastructure to AI companies.
The demand for HPC capacity right now is it's astronomical. And critically, it's stable. Unlike Bitcoin mining, which is a race to the bottom on cost, HPC contracts are typically long-term fixed-price deals
That provides a clear path to stable, recurring revenue stream.
that are totally decoupled from whatever Bitcoin's price is doing on a given day.
So if you're looking at this company, you aren't just betting on Bitcoin doubling. You're investing in a company with a nearly billion-dollar bank account and a strategic foothold in the AI boom.
That is the core high-level thesis from the report, that AI pivot should, by itself, merit a higher valuation than a standard miner.
Okay, that brings us to the elephant in the room. I have to play the skeptic here. If the fundamentals are this good, 156% revenue growth, huge cash pile, a smart AI pivot, why on earth is the stock trading around 267?
I mean, the market's supposed to be efficient, right?
It's supposed to be.
And that is the paradox. It's what the analysis calls the bear trap. It suggests that short-term traders, and frankly, the trading algorithms, are getting misled by noisy or incomplete information.
So what's the noise? What are the reasons?
The report identifies two primary reasons for this suppressed price. First, the earnings miss headline. Bitfarms reported a GAAP net loss of $46 million.
And the algorithms just see the word loss and sell.
They see loss, they trigger automated selling. It doesn't matter what the fine print says.
But the fine print is where the truth is. What actually caused the loss?
The analysis clarifies that this loss was almost entirely due to one-time non-cash charges. Things like equipment depreciation write-downs, technical asset reclassifications, stuff accounting rules require.
So not actual cash going out the door, not an operational failure.
Not at all. As we established, operations were stellar with $69 million in revenue. The market basically sold the accounting noise and completely ignored the operational success.
Okay, that happens. What's the second reason for the fear?
The second reason is just one word: dilution. They raised that massive war chest through convertible notes.
Right.
And for short-term traders, any convertible offering triggers this immediate fear of future share dilution. They see the potential for millions of new shares hitting the market down the line, and that puts pressure on the stock price right now.
So the market hates the method they use to get the cash, even if the result, that massive liquidity, is a huge long-term benefit. That is a real trade-off.
It is. The analysis suggests the timing was key. They raised cash during a period of enthusiasm to lock in favorable terms, buying stability and the runway for their AI pivot at the expense of this temporary dilution anxiety.
What's fascinating here is the contrarian takeaway from the analysis is that these fears are probably already played out.
Precisely. The cash is in the bank. The quote-unquote bad news, the headline loss, the dilution risk, it's already baked into that 260 share price. The analysis suggests the panicked sellers have already left the building.
Which makes the technical side of this absolutely critical, because if the fundamentals are screaming undervalued, the chart tells us when the market might finally start to listen.
Right, let's look at the trading levels. We've seen really consistent behavior around this price. The analysis identifies massive support at that 250 to 260 level.
A floor.
A very dependable floor where buyers consistently step in and stop it from dropping further.
Is there a specific example from the report that shows that?
Yeah, absolutely. It highlights a specific bounce on December 24th. The stock saw this really swift intraday reversal. It dropped to 258 and bounced all the way up to 271 on high volume.
So buyers jumped in immediately at that level. That floor is firm.
Very firm.
So if 260 is the floor, what's the ceiling? What's the trigger that tells us the skepticism is finally breaking?
The critical technical trigger is $2.80. That's the key resistance that's been holding it down for weeks.
So a clean break above 280 on high volume.
That's the signal. It suggests the short-term resistance is broken, and it could trigger momentum algorithms to start buying.
And after 280, what's next?
The next immediate psychological target is $3. Breaking that $3 mark often brings in a whole new class of traders.
And when we look further out, where do the professional analysts see this going, assuming they're factoring in all this growth and the AI angle?
A consensus is very optimistic. The analysis we reviewed cites an average price target of $5.36. Some of the higher targets go up to $7.
So from the mid-$2 range, you're talking about a potential 100% plus upside.
It's the definition of a high-reward setup, provided you believe the market will eventually catch up to the fundamentals.
This has been a really fascinating deep dive. We've covered this classic split, a company doing, well, everything right. Massive revenue growth, nailing efficiency post-halving, securing a huge amount of cash.
And making a really smart strategic pivot into AI for stable long-term revenue.
Yet it's being valued by short-term traders based on dilution fear and temporary accounting charges.
So what does this all mean?
I think it means the analysis points to a dramatic disconnect. You are getting a company that has proven it can grow revenue by 156%, holds massive financial leverage, and has a real foothold in the AI sector, all for less than $3 a share.
And that leads directly to the final verdicts from the analysis report. BITF is considered a high-risk, high-reward buy. The risk is, it's tied to the crypto sector's volatility, but the reward is tied to this verifiable structural change in operational excellence.
And if we connect this to the bigger picture, that 280 breakout trigger, it isn't just a technical signal on a chart. It could be the market's first real confirmation that the valuation is finally catching up. Not just to the 156% growth, but also to the successful launch of those AI contracts.
Which raises an important question for you to think about. When the price does cross that threshold, is it the AI pivot that truly fuels the move toward that 536 analyst target? Is that what finally shifts the narrative from just another volatile mining stock to a stable critical infrastructure play?